The golden pocket strategy I'm about to show you has helped me take an account from 36,000 to 863,000 in about 3 months. After 11 plus years of trading and making over $11 million in trading profits, is one of the concepts I've kept closest to my chest until today. While everyone else is chasing the latest indicator or holy grail system, I've been quietly finding perfect entry with minimal risk. It's so effective that oftentimes students ask me if it's even legal to have this kind of edge. Today I'm breaking down my complete golden pocket framework. What is it, how to trade it, and how to combine it with other strategies like SMT divergences to make it even more powerful. Let's talk about the golden pocket. Probably the most famous and most used tool I created using the Fibonacci. The golden pocket essentially will be more often than not your best entry into a trade to follow a trend. This means it'll be the highest risk reward point if used correctly. This is going to give us minimal risk with great entries and potentially great reward. But why is the golden pocket of any importance? The golden pocket refrains from the 0.618. The 0.618 is the golden ratio that we've seen all through our life. In nature, paintings, through history, 0.618 has always been an important number. Then I personally added the 0.66. That's what makes the pocket 2 key levels. So golden pocket, if you're going to go to your Fibonacci settings, which is going to be onto your left, you're going to open them, go to your settings, and you're going to use these two, 0.6 and 0.618. We think about logically if you are thinking about a trader. At the end of the day, all trading is human emotions in the form of candlesticks. If people see a price skyrocket up, you're not going to want to chase the top. You're not going to wait for FOMO. You're going to be waiting for price to retrace to find an entry. And since human emotions repeat themselves, we found that more often than not, using the 0.618 and 0.6x has proven to be a really great entry when following a trend and using it in confluence with other trades. This is where we find our entry for then our next leg higher. And the second leg higher tends to be a more shallow pullback versus the first leg. When an asset makes an initial move, a lot of people are skeptical. And because they're skeptical, it's going to give them a deeper pullback. This is what we get, 0.618, 0.66. Then after that second leg, the next pullback tends to be a lot more shallow and not as useful. We want to find the optimal entry, which will be our golden pocket. If we look at this clean example here, we have fibbed out the bottom right here of the pre-market around 5,505, all the way to the top right here, 5,545. This then caused a new candle. The news candle drops down right into our golden pocket to then push all the way up to the opposite hand of our Fibonacci extensions, showing you that the golden pocket is a really, really powerful tool that is used by institutions to look for those dips and where to buy them. How do we use it and apply it properly? To understand what the golden pocket tool is, if it is a trend continuation tool, it means we must look for a trend. If we're trading within chop, it is not useful. We must wait for a trend, which could be either bullish or bearish on any time frame, to then use it. If we see from this example here, we can take the latest green candle, which was the latest high in this example, to the pre-market lows and see where price retraces to, exactly to our golden pocket tool, in combination, in this case, to a bearish parabolic gap for a really clean rejection. Use key points to mark out your lows and highs of the golden pocket. Use the wicks, not just the body. If price has reached its level, it should be used. Do not just mark out the body, use the wicks as well. When is the best to be used? The best way to use your golden pocket tools is to combine it with a larger time frame market structure that follows the golden pocket trend, such as a bearish parabolic gap like we saw in the previous example. Can be very strong, used with previous day's highs and lows or pre-market highs and lows, as well as news. Use in combination with the only market structure you need, which is your accumulation, manipulation, distribution, to pinpoint your entry. This is when the golden pocket tool is used to find exact entries. Golden pockets will almost always give you some kind of move, but you need to always wait for a candle close to confirm the pocket. Don't just blindly enter, wait for confirmation of the candle closure. Let's go over another real clean example. Here we have price make an obvious move to the downside. We have the latest high marked out by the candle. We have the key previous low that gets flushed, a larger time frame for value gap, which is a bearish one. We have the lowest point of that trend, which also ends up to be a pre-market low. We see price, market opens, retraces exactly to the bearish golden pocket, combination with the bearish for value gap and a key previous low to give us a rejection for then price to continue lower. That would have been the optimal entry with the highest risk to reward trade that you could have caught. Now let's look at an example that I actually traded live with the team today. We have an obvious high right here being the Friday high. We can mark down all the way to the low of this trend. Again, we're looking where is the trend. We're not flipping out this random chop here. We need to find an obvious trend, and as we can see here, we have this obvious bearish trend here. Now we don't want to chase the bottom here. We don't want to go just short anywhere in this trend. We're looking for the most optimal entry. This is where we use our golden pocket. Get the high to the low on this larger time frame, which is the 1 hour, to look for where should we more than likely be short. And more than likely it should be within this golden pocket. As you can see, in 1 hour, price hits into golden pocket and it ends up with a 1 hour bearish fair value gap to give us added confluence and then closes right back below it. This should give us a confirmation, and now we can look for a smaller time frame entry to look for bearish setups. Then we will jump in straight to the 50-minute time frame to see if there's anything to note. We do have a bearish fair value gap here that gets created, but I think even better than that, we can jump to the 5-minute and look for even more added confluence. We see here that we have a really small bullish gap that gets disrespected right there. That could give us a potential entry on this next candle, and using this as a potential stop loss, it would look something like this. But now let's say we missed that trade and we need to look for something else. Now we know that if we hit this bearish 1 hour gap, we should only be focused on bearish setups, which means all these bullish levels here, I don't really care for as much. I'm focused on the bearish levels. This is why sometimes whenever you use a confluence, you're not using it properly because you're not understanding if price should be bullish or bearish now. For example, here I see I create this bearish 5-minute gap right here. I could mark this out and understand, hey, because I rejected the 1 hour bearish gap, now the smaller time frame, since time is fractal, should stay to be bearish. This hits it, you see price rejects, you can enter, stop loss above that high or a candle closure above the fair value gap and look for the next leg down to the next low, which in this case would have been 20,068. Now you see I'm using golden pocket not simply as a buy and sell tool. I'm using it for a way to trade. I'm using it to give me a bias. I'm using it for confluence for added trades based on a larger time frame golden pocket. This is when you're gonna take your trading to the next notch, when you don't just use a tool to be like, oh, do I need to buy or do I need to sell? Like, that's all you're using it for. No, you're actually understanding the concept. I'm understanding that on the larger time frame, I'm bearish because I created a really big move to the downside. Then I retrace into my golden pocket and now I'm having another big move to the downside, which means that my most likelihood and best probability setups are going to be bearish setups to look after that happens. So if I'm finding a 5-minute bearish fair value gap, I'm not looking for it to be inverse. I'm actually looking for it to take the continuation move to the downside, and the bullish levels that I had from previously, I'm not really looking to take trades off of them because of where I rejected on the larger time frame. We understand that price always has 3 phases: accumulation, manipulations, and distribution. Which one is the best phase to actually trade off of? It is our distribution phase. It's going to be the cleanest and going to give us the largest move. Accumulation will be a ton of chop, and manipulation is very tricky to time because it can give you fake moves. So the distribution phase is the one where we want to capitalize the most, and the golden pocket is giving us the tool to capitalize the most on. As you can see here, we have price accumulate here on the left side. As it accumulates, it creates a fake move to the upside, which then gives us a big distribution back to the downside. While you could try to chase the distribution down, it's always best to stay patient and wait for a retracement to then continue this overall bearish trend. Look at where the bearish retracement happens. Guys, this is a different example from what I showed you guys here. This is a completely different day, but this is looking very similar because these patterns repeat themselves day in and day out, and all you need is yourself to stay patient to actually catch them. As we can see, price retraces perfectly to our golden pocket and then gives us the next leg of distribution all the way down to our external range of liquidity to take full TP right over here. It's really important to understand with trading, you need to catch the exact top and bottom of the day. You need to find the perfect entry that's going to give you the highest potential reward with the lowest amount of risk. This is why adding golden pocket to your tool of bags to find trades can change your trades completely. It will eliminate FOMO, it will eliminate the not knowing where to enter a trade, and it will help you gradually becoming a much better trader. Now I understand why the golden pocket has been my secret weapon for years. While it's not actually legal, this edge definitely feels like it sometimes. If you want to see how I'm able to catch these setups in real time and how you can learn as well, I highly recommend you check out my mentorship. Unlike most YouTube gurus, I'm actually in the trenches every single day with my students, hands-on, teaching them live. If I had an opportunity like this 9, 10, 11 years ago, it would have been a no-brainer to jump on it. The link is in the description down below if you're interested. Thanks for watching, and I'll see you in the next one.